Hello, David and Tom Moore. Today, the 1031 bros typically, but we're the retirement bros today, huh, Tom?
Yep, going to talk about some self-directed IRAs.
For future context, it is mid-July of 2025, and we've been doing a lot with the 1031 content, but we haven't done much with the IRA stuff. So this is going to be sort of an intro. We're going to go over some basics of self-directed retirement accounts, what's possible, how to put them together, how to make an investment, some of that. And Tom, why don't you start off just why we got involved with that space and what we do. So.
Sure. How we got involved with it.
Yes.
So probably in the early 2000s, we had a lot of our 1031 clients were inquiring about using IRA money for real estate investments. They're all obviously real estate. They believe in real estate investments. They're real estate investors, but all of their retirement dollars, as far as IRAs, was invested into stocks and bonds, mutual funds, stuff that they didn't so much understand. And so we started looking into what role we might be able to play. Did a lot of research, and are we going to be a custodian? Did we want to be a TPA? Didn't really want to be either one of those things. So we figured, well, we've always been involved in just getting people into a structure so that they can do what they want to do with their money and not be on the selling and not providing investments themselves, but just giving them a tool with which they can go out and do their own investing. So fast forward to 2008 time period, we had a lot of free time on our hands as there were not much, 2008, 2009, not a lot of real estate transactions taking place. 1031 was pretty slow. So we put together IRA Advantage, and we act as a facilitator to get people out of their current accounts, whether they're 401k plans or IRAs, but we get them into self-directed accounts, and we'll take them from where they are currently, open up new custodial accounts, and then put them into whatever vehicle may work best for their investing. And so we do a lot of consultation with them and find out what they've got, what they want to do with it, and help them get into the right structure that will help them to go out and buy what they want to buy. So we deal self-directed IRAs, IRA LLCs or checkbook IRAs, solo 401k plans, rollover business startups. Those are.
So really, it's if you look at in the taxed world and you look at what we do in that space with 1031, we're just the conduit out of what they don't want into what they do want, and we provide the investment vehicle to get them there. And the retirement side, qualified money world, we're really doing the same thing. We just want to know what you have and what you want to do with it. And as Tom said, I mean, it was really interesting for us because our clients kept coming to us and said, hey, I understand we can do this stuff. And I remember going to seminars, presentations, different people, and typically I'd walk out understanding how to make the investment into what they wanted me to buy, but I really wouldn't understand anything on what really is needed. And if we look at the process, it's not very complicated. I mean, you think about 1031, I always say there's four basic issues. It's got to be an exchange, what's going to receive for like kind. You've got to satisfy what we call the napkin test, cross-reference value and equity, and have to have continuity vesting. If we look at and the toughest thing with any exchange is always going to be time, and the second is vesting, just because the complexity of what's a partnership, and partnership interests don't qualify, and finance world not meeting eye to eye with the tax world, and so on and so forth. If we look at the retirement space, we're looking at two issues. What do you want to buy and who you're transacting between or for the benefit of? And I think the thing that you got to understand is if you go talk to your financial advisor about this stuff, he or she really understands the investments inside out, and they can provide you great advice on getting in and out of certain investments. But as far as when you start looking at what an IRA or a 401k plan can truly do, they really, that's not in their wheelhouse because it doesn't need to be. And I guess, sort of a a word of caution in this space is if you've got a Wall Street IRA, you can obviously pick a very poor investment and get mad at yourself for that. But you really don't have the opportunity to commit a prohibited transaction, where in our world, you have to be very, very careful. So, Tom, I don't know if you want to sort of explain a little bit about that. I mean, prohibited transactions, what would constitute one, disqualified parties. Any comments on
yeah,
those?
and maybe we can jump into probably the most common structuring that we put together for people would be an IRA LLC or a checkbook IRA, and it's if somebody comes to us and they want to go out and buy a single family rental with their IRA, or maybe that's the first thing they want to jump into, we'll set up an IRA LLC, and it's a pretty simple process. We open up a new custodial account for them, add a self-directed custodian, and it can be a traditional IRA, it can be a Roth, it can be a simple, a SEP. All the different types of IRA accounts are available from a self-directed custodian. And people will say, well, I've got a self-directed account at XYZ big broker, and well, they may have an IRA that's termed self-directed, but really just is giving them the option to choose from a few different,
So their definition of self-directed is a little different than our definition of self-directed.
Exactly. They're not going to allow you to go out and buy real estate. They're not going to allow you to go out and make loans to builders or anything like that, which you can do with a truly self-directed custodial account. So we get the account established. We then form an LLC for them, and it can be in any state. Typically, it's the state in which they are either investing or in which they live. But we'll register an LLC, get them an EIN for the new company, provide all of the operating agreements, and so everything that the custodian needs in order to invest that money that they're receiving into this new LLC as the investment.
So Tom, a lot of people out there might say, well, gee, I can go to LegalZoom and get a limited liability company, or I do them all the time myself. I guess two comments on LLCs. If you just get the articles together, do you have an LLC? I mean, what else do you have to have? And then if you're looking at somebody just wanting to bare bone, because we have a lot of people that contact us, well, I have an LLC, or I can do that, and they want to use their stuff instead of ours. I mean, comments along those lines?
The LLC that is going to meet all the requirements for an IRA investment is very different than a standard LLC that you or I may go and establish on our own someplace. Or, we get that all the time. People will call us up and say, well, I just set up an LLC. I haven't used it yet. Can I use that one? And 9 times out of 10, the answer is going to be no. They will have themselves listed as a member, or it's just not the structuring that we really want it to be.
And even if they have the articles done, even if the articles show that it might be something we can use, but the operating agreement's not going to be anything remotely.
The operating agreements, we get contacted all the time by people that have been trying to get operating agreements approved by custodians, and they can't get it done. They'll have attorneys involved. Most of the attorneys don't know what they need to put into these agreements in order to satisfy the IRA investment needs. So we've been doing it for a long time now. When we go to a custodian, we know that all the custodians that we work with, they've all seen our documentation time and time again, so they know that our operating agreements are up to snuff. They've got the latest information in them. So, we get everything put together for them. We give the custodian then instructions to invest the money into this new LLC. The client will have established, they're the manager of the LLC. It's a manager-managed company, not a member-managed company. So as the manager, they go to their local bank, open up a bank account for the LLC, and now we've got a place to direct the custodian to send money when they make the investment. So it's a pretty neat setup. Usually takes about a month to get it put together, but pretty neat setup. As soon as this is all done, we've taken them from their existing IRA into really a company that they're the manager of, that's got cash in the bank, that is owned by their new IRA, their self-directed custodial account IRA. And now they can go out and make investments on their own. They don't have to go to the custodian and get the approval of the custodian to make the investments. We go over all of the rules as far as what constitutes prohibited transactions. But, if they want to go out and buy a piece of real estate, they can go out and buy it in the LLC's name. They write the check for earnest money. They negotiate everything on their own as the manager of the company. When it comes time to fund it and buy the property, they'll write a check or wire transfer out of their LLC bank account. And it's really a quick and easy process. You can have the custodian of a self-directed custodial account buy in the custodial account name, but it's a very cumbersome process to do that.
With that comment, it was sort of interesting, like I said a couple minutes ago before we started, that I had come across some information. You gotta love AI, gotta love Google, all this stuff these days. But you look for one thing and somehow you end up over there. But it was somebody in the 1031 space explaining, oh yeah, this is how you use a self-directed IRA. And I was confused. Okay, are they in the business? Are they not in the business? So they're giving this information on it. But it was talking about a basic self-directed IRA. So I guess a couple comments or questions for you, Tom. Are all trust companies created equal? I mean, we have to be careful who we're working with and what their requirements are, what they're going to allow with respect to management of the entity or what they're going to require with a checkbook IRA, right? And then also, really differentiate. So technically speaking, and Gary years ago, our outside legal, we've got the checkbook advantage IRA is what our copyrighted name is for our process. But really, you're just sticking an IRA-specific limited liability company between the trust company and the ultimate investment, right? So, but why don't you sort of explain maybe some of the trust companies and what we've seen different requirements of it. So the trust company can dictate how cumbersome something is. And if we really look at a self-directed retirement account, in the most basic sense, since it's not a legally defined term, we're just moving money from a trust company that won't allow you to do what you want, as you said earlier. Maybe it's one of the big Wall Street firms. Their self-directed is a totally different definition of our self-directed, but you're going to move from there to a trust company that will allow it. If we're looking at 401k plans, we're going to take a look at the plan and see if the plan allows the investment. If it doesn't, can we amend the plan or we'll replace it with one of ours? But comments on the trust companies and different things we've seen, and it is a moving target too, because some of them we've had relationship with for a long time. They've sort of changed their requirements over time and added different.
Yeah, there's certainly been changes just since we've been involved, and we started really in 2008, formally in 2009. But a lot of the companies, the self-directed custodians, have been purchased and moved and changed hands. Most of them are doing pretty well, I think. They've grown and undergone some growing pains. But the thing that because most of our transactions involve these the self-directed IRA, LLCs, checkbook IRAs, one of the primary things that we have to look at is, first off, will they allow that as an investment? And at the beginning, it seemed like there were a few of them that really sort of frowned upon it and didn't like the idea of it. But I think all of them really allow the IRA LLCs as an investment now. It's been pretty universally accepted. After that, the next question is, okay, the whole idea of these things is to give the client ease of going out and buying investments on their own. And that's why these things are, they're manager-managed companies, and the IRA owner is the manager. There still are some custodians out there that, although they may allow the IRA LLC as an investment, they don't allow the account holder to be the manager, which really is sort of defeating the whole purpose. Because if they've got to go out and have somebody else manage the LLC, then they're right back to delays in making investments and making it more cumbersome.
Well, so I mean, just explain to the audience. I mean, think of what that means if you're not the manager of the LLC, or if you look at a basic self-directed IRA making an investment in real estate. Why don't you talk to through those two processes? I mean, it's really can get very cumbersome.
Yeah, and the whole thing is, it's not like it's not like just because they're not allowing the account holder to be the manager, they don't want anybody really that's considered to be a disqualified party to be the manager.
So I don't think we've talked about it. Who's a disqualified party to your IRA?
So a disqualified party to the IRA would be first and foremost the IRA owner. They're going to be a disqualified party, and after that, you're looking at spouses, family members of lineal descent and ascent. So if you've got, if I'm the IRA owner, I couldn't have parents, grandparents, children, grandchildren, anybody lineally in my descendant order would not, they'd all be considered to be prohibited or disqualified parties. And if I made any investments that were in any way benefiting them or they were benefiting the investment of the IRA, then you've got a prohibited transaction. So it means that I couldn't go out and buy a rental house, for example, and have a son or daughter living in that investment. That would constitute a prohibited transaction. Also could not have, if I had a son that was a plumber or did yard work, they could not do anything on that property, nor could I. Anybody that's disqualified, could not do any work on the property, whether they're being paid for it or not.
Sweat equity is not okay.
Yep. The IRS is going to say, well, there's a beneficial relationship between the disqualified party and the IRA, therefore we've got a prohibited transaction. Interesting.
So what about entities too? So we've got lineal ascendants, descendants, their spouses.
Yeah. So same thing with companies that you may own. A 50% or greater interest is going to be a related party, disqualified party issue, and actually, our attorneys don't like for there to be anything really over about a 25% or 25% or greater interest, because then you've got some plan asset rules that come into play and they can create problems. So you really want to stay away from having any companies that you have any significant ownership in doing any work on the property or leasing the property from you or anything like that.
So we had somebody, so I guess one thing I'll say is so it's a prohibited transaction to transact between or for the benefit of disqualified party. It's not a prohibited transaction to transact along with. So you could be a co-owner of something. And if you've been on our YouTube channel and looked at different things, you've probably seen me talk about two different ways to own property jointly with your retirement account, either tenancy in common, which would be required if we're looking at 1031 into it, or as common members of an LLC, and really each has its ups and downs. But so our sort of position on multi-member, so you can have a multi-member entity with disqualified parties as its members, is that something we think is a good idea? And then also we had in the last few weeks, I remember you came into my office discussing an issue we had with one of our investors and an investment they'd made for lending maybe and structure that thing. So as a no-no example.
Yeah, and I wanted to touch real quickly back talking about the disqualified parties, and we talked about family members of lineal descent. You know, interestingly enough, if you look laterally to siblings, aunts, uncles, nieces, nephews, none of those parties are considered to be disqualified parties. So you can have transactions where, you know, I could go out and buy a rental property and maybe it's a vacation property and you as my sibling could go and rent that property or I could get you to do some plumbing on it or something like that. That's fine.
You've seen Tom working on my boat, so yeah, that's a hint. But yeah, I mean, so it's really, you got to do your homework. And once again, for people that have been on our channels before, Tom and I used to do a lot of scuba diving and together, and it's like plan to dive the plan. And in this stuff, I really feel like it's not that complicated, but you really got to figure it out and be cautious when you're getting started. Be ready to go do what you want. Don't call us up when you've got a purchase pending and you got earnest money down on something because it's too late for us to put it together. You got to really make sure the investment vehicle's set before you go make the offer. And with that said, I mean, if somebody's going to go out and I did ask you to sort of talk about that multi-member entity with that deal, so you can talk about that real quick, but then maybe talk about with an IRA LLC buying a property versus a self-directed account, because like you said, if it's a basic account, and that's sort of the explanation I got off the website this morning, it's very cumbersome, and I don't even know how you do the deal. I mean, because as Tom said, sweat equity is not okay. You can't tie up a person. You couldn't go out and buy a property, tie it up personally, and then assign it over your plan. That's a prohibited transaction. Working on a property, as you said, sweat equity is not okay. And people always ask me, it's like, well, why is that not okay? I'm not compensating myself. I said, well, yeah, the government should like it because you're increasing the value of that retirement account, ultimately converting to more tax revenue for them at the end of the day, but they're having to forego. The only rational reason I can see for that is they're foregoing all the tax revenue from all the vendors working on it today. So they're giving up all that today for the promise of something in the future, and they just don't like that, I guess. But anyway, so.
Yeah, lot to cover there. Talking real quickly about joint ownership on these things, you can certainly have multi-member IRA LLCs if you want to. So it's very common that we get new clients come in and husband and wife, they both have IRAs and they want to set these up so they can use both of their IRA monies to go out and make investments. So they can look at, first and foremost, do they really need money from both of their accounts to make the investment, or is it something that they just want to throw some cash in from each one of them? If they can get away with not doing it with both accounts, if there's a piece of property that they want to buy and they can do it through one of their IRAs, it's better off to do it that way and just set up an IRA LLC for that IRA account itself. So we've got a single member IRA LLC. If it's single member, it's a disregarded tax entity. There's no reporting that has to be done. If they said, no, we really have to have the spouse's IRA come in as well, then you're looking at either setting up two individual IRA LLCs, which we prefer, not because it's more fees to us, but it gives them more flexibility down the road.
And those two entities would be tenancy and common owners of the property, or they could be...
Yeah, they can go in either as tenant and common owners. You've got two IRAs going in and investing in the property, or we could set up a second tier LLC where both of those LLCs are now forming a partnership to go out and make that investment.
So you've talked about that twice in the last couple minutes. Multi-member, there's some more paperwork that's got to be done if it's not a disregarded entity, right? So they're now filing a return for that.
Yeah, if you've got a partnership, then if you've got a partnership LLC that's made up of two self-directed IRA LLCs, or even if you had two IRAs going into one of them, yeah, now you've got a partnership. There's K-1s that have to be filed, partnership return for a partnership LLC. So yeah, there's more tax filing that has to be done for that.
And what's one of the other issues that comes up if let's say you and I, that's not a good example. If CC and I are going to go out and buy something together and we do it, we just say, hey, we don't want to create two entities. We want to just do the one. And now we're in here and we need $250,000 to go make the investment. What's the likelihood of that $250,000 being all we're going to need, and if we need more for something, what has to happen, or what minefields are potentially there if we do that?
Yeah, no, that's a great question, because anytime you've got a situation like that where you've got money coming in from multiple, if we set up one IRA LLC and it has both your IRA and your daughter's IRA as members to it, that's okay, even though these IRAs themselves are considered to be disqualified parties with one another. As you mentioned, it's not okay to transact between one another, but you can go into investments alongside one another. So as long as the initial structuring of that IRA LLC, both of your IRAs are going into it at the same time, that's fine. Now you've got this entity that can go out and buy property. We want to make sure that you've funded that entity with enough cash and have reserves so that you can go out and buy the property. If any work needs to be done to it, great, it's sitting there to do so. But if you go out and make the investment and you're short on something a month or two down the road and the LLC now needs more cash, it's not a good idea to have either one of your IRAs bring more money into the LLC. Because basically what you have to do is you have to go back to the custodian and say, okay, buy more shares of this LLC with this additional cash. Maybe you've transferred it from another IRA or someplace, but if you're doing that, now you're buying into an LLC that is jointly owned between your IRA and another IRA that is a disqualified party. There are some custodians that seem to be fine with it. There probably isn't anything out there that is saying you can't do that. But again, if you want to be conservative, our attorneys don't like it, and I don't like it.
So what about if I want to combine let's say my traditional IRA and Roth IRA into an IRA LLC?
Yeah, same situation, because those are separate entities that are disqualified parties from one another, the same as you and your daughter's IRAs are. And it's not just IRAs. I think you touched on briefly before. We could have a situation where you've got some IRA money and you want to go out and buy a piece of property. The IRA doesn't have enough money in it, and now you're in a situation where you either have to go out and get some financing to make up the difference between your IRA money and the purchase price, or maybe you personally have got some cash in the bank you're not doing anything with and you want to throw that in. You can certainly do that, so you can have an IRA and you as an individual or any other individual can go in, whether it's a disqualified party or not. You can go into the investment together as long as you're doing so at the same time. If you have parties that are not disqualified parties, if we had an IRA LLC, you mentioned before real briefly, if you and I went into an LLC together and we formed an IRA LLC, then because we're not disqualified parties, we can bring in additional cash at any point in time.
Makes a
afterwards.
Big difference.
Yeah. So if you have your own IRA LLC, or if you've got an IRA LLC that is owned by parties that are not disqualified parties, then there's no problem in bringing in additional cash after the fact. You don't have to fund it all at once and have reserves sitting there.
So we're talking about a variety of different things, and I think
we're all over the place.
Yeah, we're all over the place. But hey, we're having fun. The deal is, I really look at all of this, and I mean, the number of tax and legal people we work with coast to coast on different things, going through this stuff, and the number that really understand what is possible or what the real pluses and minuses are. I mean, 2 weeks or last week we had the conversation with the one trust company that all of a sudden out of nowhere had sort of black-lined or redlined some of our operating agreement, and all of a sudden we finally we get on the phone with the owner and say, hey, what's going on here? And at the end of the day, they apologized and said we didn't have to change anything. But when I started getting into it with them, it's like, okay, so what exactly? Where's the issue? What's going on with this stuff? I guess what I'm saying is people don't. If you're not familiar with it, you're not working with it. And I guess a prime example, you remember this is probably about 10 years ago now, we did the one basic self-directed IRA for one of our local investors. And, she's a very high-powered business person. And I know her, I know how she is. And she didn't want to pay for the IRA LLC. And because she was just putting some money into some projects that a friend was going to do, some fixer projects, and that friend was not a disqualified party. So she was just going to make quote unquote make a loan to her to go do these things, and that could be accommodated through a basic account pretty easily, just with some patience. But I told her at the time, I said, I don't think you're going to like it. You're not going to be happy with it. And, well, okay, we'll just do this. And then, I don't know, a year later, she's all of a sudden calling us up because her lawyer's not able to provide an operating agreement that the trust companies are going to accept. And so she ended up paying that person 3 times what she was going to pay us, and wanting us to teach the lawyer how to do it. And it's like, no. So I think, we're, like Tom said, we're sort of all over the place. But I think what it was important for you to understand is when people come to us, what they're really, what you're paying us for is the experience. And we can sit here and talk to you because we've gone through these things. It's not something that's, if you go Google it, or in today's world you want to go AI something, it's not going to apply to what you got going on, and it's out of context, I think.
Yeah, you're not gonna get any information. Where do people have problems with this stuff? And we've been doing it for long enough that we know where people have problems. We've seen them have problems, and it doesn't matter, even though we'll go through all of the prohibited transactions, disqualified parties. You go through and lay all it out for them. The great thing about these is that you've got full control over your money with your IRA, and you can invest in what you want. The big problem with them is you've got full control over all of your money in your IRA, and you can invest where you want. So it's,
if you want to blow it up,
yeah,
you're going to blow it up.
So yeah, you do have people that will abuse it, and they'll run into problems. And so yeah, you really have to know what you're doing. And we'll always encourage people, if you're getting ready to make an investment, and you're getting ready to write a check, you have any doubts about what you're doing, call us. And take a 2-3 minute phone call usually, and we might be able to save you a lot of headaches, or tell you, yeah, great, you're on the right track. So.
And we've got a number of trust companies that will send people to us to get those questions answered too, for a variety of different things. But, I guess what I like to say, none of this is new. I mean, it's been possible since retirement accounts started in the mid-'70s. So this is not a new topic. It's just, I think, a well-kept secret. And I think the thing that's sort of testament to that is, remember, it was a couple months ago, you and I were speaking to the conference down there in San Diego, and we're talking primarily on 1031s, but we had the one breakout session where the one broker said, hey, you guys talk about retirement accounts and go and buy this property. Well, why would you do that? And I remember saying, well, why wouldn't you? And typically we get the same old arguments over and over again by people. It's like, well, why shouldn't you do it? And I think his based upon the short and long-term capital gains tax, or what was the objection?
I can't remember if it was that, but that'll come up. Or I don't get to take depreciation,
interest
right?
deductions,
you don't
depreciation,
yeah,
writing off your trips to check stuff out, or
that comes up a lot. I've got to go write off a business trip. I'm going to go check on my IRA investment. No, you can't do that.
Buy the hotel,
yeah.
do the whatever it is. Yeah.
But that stuff pops up, and because you can't personally take those deductions, or you don't get all those benefits that you might with individual ownership, doesn't make it a bad investment.
Yeah. And in that situation, I think my response back to him was something along the lines, it's like, well, yeah, you're right, you don't get that benefit, but what can you sell me that's going to give me that benefit? And he sat there quietly, because they don't think that way. I think there's lots of them that sort of have talking points from the parent company. Hey, this is how to sort of torpedo somebody that wants to do some of this stuff. So I just want you guys all to know this is not new. It's been around for a long, long time. The IRLC's been out there for a long, long time. So what we're talking about is time tested. It's just a very tightly kept secret, I think, for a variety of reasons. But if you've got questions in that area, please don't hesitate to reach out. And with that said, we have a series of sort of talking points that one of our coordinators wanted us to address this way. So I think before, like you said, we're all over the place. Maybe I'll channel it into these before we continue to do that today. So, the proper care and feeding of I think you talked about it for a multi-member LLC. We've got that multi-member IRA LLC. I think you talked about that. Plan ahead, get it funded, put more in it than you think you need. Don't get yourself in a situation where you're going to have to add funds at a later date. But just in general, proper care and feeding of a self-directed IRA. So after it's put together, you mentioned it takes about 3 weeks a month to put the thing together. But ongoing, what can the audience expect as far as their ongoing sort of annual responsibilities to keep one of these things working correctly?
Yeah, so it's an LLC. As far as the custodian is concerned, you always have to have a custodian in place, and that's one question that pops up is, why do I have to have a custodian? All my money is going to be in this LLC. Well, just like any IRA account, you probably have most of your money is always invested into something. It's not sitting with the custodian. You might have a little bit sitting there, but most of it's usually invested. In this case, it's just invested into a privately held company. But you do have to have the custodian, so you'll have custodial account fees. Typically they're probably going to range somewhere around $100 a quarter or so. I think it's pretty standard. Have to check with our people to make sure that I'm not off much, but I think that's where we are generally.
I think we're there in general. There's a couple that are a lot less, but then benefits and pitfalls, right?
Yeah, so you've got those fees, and you've got to have the custodian because they've got to report the value of your IRA annually. So you've got to go out on an annual basis. You're supposed to provide a valuation back to the custodian, and really what it looks like in general is they'll send you a form via email. You'll fill out what your IRA LLC is worth because they have no idea. It's not a publicly traded company. They may know that you've got X number of shares from that initial investment, but they don't know what the shares are worth now. They don't know what.
So they want to know all cash and assets that the LLC has annually.
So if the LLC has bought a piece of property and it's got cash in the bank, then you can provide a valuation of the LLC basically through you have a market analysis done of the property. You don't have to go to the extent of having an appraisal done, and you report the value of the LLC. So all the assets, cash and assets, total it up, give them the value of the LLC. When it comes time where you're taking RMDs at age 73 now some of the custodians are going to want to have that form signed off by somebody else. So
typically the annual valuations come, for example, a piece of real estate. Who would provide that value typically? I mean, annually. I mean, if we're not talking about taking something in kind, if it's just an annual valuation.
The manager of the LLC, which is the IRA owner, will fill out that form and send it back to the custodian, and what they're using for the valuations, we'll tell them probably a good way to get a value would be through comps. Have your local broker, whoever maybe who you bought the property from, could run a property analysis for you each month. It's going to be in sort of an arbitrary.
Yeah. So if you're the broker that sold the people the investment, stay in touch. They need you. And then probably they'll come to you when you go full cycle on it too. Yeah.
Yep. So that's another thing. You've got to provide value, and it's a pretty easy process. The LLC has to be renewed annually, like any LLC. So we actually will act as registered agent for a lot of the clients that set these up if they want to be hands off basically and have most of the stuff taken care of for them, then we can act as a registered agent. If we're doing that, then we will provide a written consent document which will satisfy their minutes requirements for the year. They could certainly, if they live in the state in which they have the LLC registered, they could certainly be the registered agent themselves for that entity or have somebody else do it too. Yeah, you've got to do the renewals, you've got to have valuations.
So Rochelle asks, proper use of your account, current IRA concerns, review of the IRA do's and don'ts flyer. So if we look at every trust company is different with what they require. And like you said, some won't allow you to be the manager of the LLC, which is a tough situation. We've had some through the years that would require the taxpayer's tax or legal counsel to sign something stating they're experts all things IRA, which they typically don't.
Yeah, or they want to have you sign a form that, in fact, one of the custodians that we do a lot of business with, they have an IRA LLC agreement that prior to them funding the investment, the initial investment in the LLC, they have you sign this LLC, IRA LLC agreement, and it's really you as the account holder telling the custodian, I'm going to have the activity of this LLC reviewed on an annual basis. And,
that's where I was going.
And here's who's doing it.
An annual review requirement.
Yep, an annual review requirement. And when we first saw that, we said, well, what do you want to have in this review? Who's going to do the review? Because we figured there's a lot of CPAs are probably not going to want to do the review because they don't know what
to look at.
They want to have looked at. And the custodians themselves said, well, we don't know. They didn't know what they just really want that piece of paper in their file saying, the client telling them that they're going to have the activity reviewed. It's covering themselves so that they don't get in trouble with somebody getting involved with a
So with that said, what we do about that? I mean, so if you look at our policy and what we've done with it, what does it do and what's the intent of it? And obviously other than accommodating their requirement.
So this is another thing that we'll provide to people, anybody who wants to, if they're hiring us to go out and put these things together, they can also hire us if they choose to do so. They can hire us to do reviews annually of the activity, because we went to our attorneys and said, okay, they want to have reviews done, or the custodians say they need to have somebody do a review on these. They want to have the agreement say it's going to be reviewed anyway. So what sort of things we need to look at? So we went back and forth with them for quite a while, and we came up with a questionnaire. It's a fairly lengthy questionnaire. I think it's 5 or 6 pages of questions. So we'll send that out annually. They'll fill it out, send it back to us. We'll review it, and if there's anything in there that pops up as a potential problem, then we will get to the bottom of what that was, determine whether or not any steps need to be taken to rectify a situation. So that's worked out pretty well for people over the years.
Does that get turned into anybody?
Just us. I mean, it comes back to us. We go through the review, and again, if there's anything that needs to be addressed, then we'll try to take care of that and get our attorneys involved if they need to be. Usually questions will get answered and there won't be any problem, but we can certainly handle things. But yeah, as far as that form's concerned, it doesn't need to go anywhere. The custodians don't require, even though they say you have to have this reviewed, they do not require that you turn anything.
Yeah. Well, I think honestly, I think it's a good thing that we're having those conversations with people annually, sort of keep them on the rails, because like you said, in the time we've been in the business, we've had some people do some pretty crazy things.
Yeah, it's not uncommon. Yeah. We'll have somebody will turn in a form to us and it says that they took a distribution that year, because that's one of the questions. Were there any distributions? And they'll say, yeah, they took a distribution, and then we can look if we are showing up as their rep on the account. We can go on the computer and see if a distribution was taken out of the IRA, and if there was no distribution taken out of the IRA and they said they took a distribution, then it's going to raise a red flag. They might have written a check out of their check account, their IRA LLC account, to themselves and called that a distribution when it's not.
So that's something that happens, unfortunately, with the trust companies. The trust companies have forms to correct that situation sometimes. But so what you're saying is, to make a distribution, it's got to, and this is assuming we've got an IRA LLC, it's got to go from that LLC account through the trust company to them. to
Correct.
make a contribution,
Correct.
it needs to take that same path too. It needs to go.
Any money in or out
Yeah.
should always go through the custodian. So if you want to put money into your LLC, it should go through the custodian channel. So, whether you're putting money into the IRA account through an IRA contribution, or a transfer or a rollover from another account into the custodial account, then it can go into the LLC. You're never going to write a personal check into the LLC. That's prohibited transaction. Same thing on the way out. If you want to take money out, which a lot of people want to do that, if they want to pull money out, it's fine to do so, but always go through the custodial account, because then they know you've taken a distribution. They can 1099 you for that distribution. Otherwise, they have no idea that money was pulled out.
So another reason people will move money out of the IRA LLC is if they want to, maybe they've got a rental house and that account starts filling up with money and from the rent, and now they don't want it just sitting there doing nothing, so they'll want to go throw it back into Wall Street. What options do they have to do that? I mean,
yeah, so they can, if they still have another IRA elsewhere, maybe they've got an account with, Edward
Schwab.
Jones or Schwab,
Fidelity.
or Ameriprise. Any of those, they can, if they still have an account there, then they can send their money back to their self-directed custodian, and then have the other custodian just request a transfer. And so it's just a transfer between accounts. It goes back into the account that invests into Wall Street. The self-directed custodians are not set up themselves very well to invest into Wall Street assets, because they've got charges for each individual asset that's owned. The other option, if they want to do that, they can have a brokerage account set up in the actual LLC's name. And that's fairly common, especially in the case like you said. You've got a rental property, it's kicking out rental income, it's building up money, and they don't want to have it sitting there earning 3% or something at the bank.
so always joking. It seems in life the easy way is never the right way. So of those two choices, you want to sort of explain the benefits and pitfalls of each of those. I mean, obviously the one moving it from the LLC back through the trust company over is a little more cumbersome, but it also provides some benefit that the direct from the LLC establishing an account doesn't.
Yeah, it's
Just for prohibited transaction situation, I think isolation.
Yeah, it's like you say, just isolating the accounts is probably the primary benefit. It can always come back at a later date if they want it to as well. But
so we're talking about with isolation. If you commit a prohibited transaction with a self-directed retirement account or an IRA, let's just say, all funds in that account are treated as distributed as of the first day in the year in which the indiscretion occurred. So prohibited transactions with IRAs are a huge problem. 401k plans, just the money involved with indiscretion. So if we move the money, you've got the money piling up and you want to really protect it all. My comment about the easy way is never the right way. The way to isolate those funds and protect everything is to move it back through the trust company, back to the Wall Street trust company or custodian. The easiest way to do it is just to have the trading account in the LLC's name, IRA LLC's name, and you just write a check, wire funds in and out of that account, and that works great. But you've got to understand that the funds in Wall Street in the LLC's account are encumbered by what you're doing with the balance of your self-directed stuff. So that's what I just wanted to stress with people. And we've had people that actually will open up different IRA accounts even for their self-directed just to isolate funds too.
yeah, because if they end up having a problem, if they've got a rental property and they went out and did some work on it, maybe they went out and mowed the lawn, and it's pretty.
Somebody was watching.
Shouldn't be any issue,
Yeah.
but yeah, they went out and mowed the lawn, and it's a prohibited transaction. So not only is that IRA investment there at risk, but if they've got that brokerage account that's also under the LLC, it's all inside the same IRA account, and the entire IRA itself can be treated as being distributed. So they may have taxes and or penalties on that. Yeah. So if you do want to put it back into Wall Street and you have other accounts elsewhere, yeah, might as well separate and decrease the risks on the LLC. It's there are certainly potential problems with an IRA LLC. That being said, most people don't have any issues with them at all. Most people will do what they're supposed to be doing. We bring up a couple of stories here, and they're things that we see. We deal with a lot of different IRA accounts. A lot of people doing a lot of different things. Most of them are doing everything the way they should be doing them. They contact us if they have questions or problems, and they can roll on. Sometimes the distribution in the future through RMDs, if they want to keep the assets, can be a little bit more involved. If somebody wants to keep a particular rental property they've got and hold it in the future, then they're going to do so by either distributing the asset itself through deeds, or they can take distributions of the actual LLC shares. So that if they've got an LLC that owns property and they want to keep the property and they're taking their RMDs, then maybe they take 5% of the property or 5% of the LLC, or 10% or 20% annually, and after 5, 10, 20 years, they can have the whole LLC owned by themselves. It's been fully distributed to themselves.
So think about what he just said. So we've spent a little bit of time talking about multi-member LLCs, and having disqualified parties as members is fine. And we have people at the end of the day that want to, if I said to Tom, I say, hey, I've got my IRA owns this property, and as you just explained, I want it. I don't want to get rid of it, and maybe So if we look at Wall Street objections to doing a self-directed retirement account, typically it sort of revolves around what we mentioned earlier about loss of long-term capital gains tax consequences or rates, which nothing you buy with an IRA or any retirement account is going to give you that anyway, so that's a pointless statement. Loss of interest deductions, depreciation, which once again is something that nothing's really going to give you. It is possible if they got a leveraged investment maybe to offset the unrelated business taxable income in that situation. The other issue that comes up is, well, gee, you've got to take an RMD. You don't have any money to take the RMD. What do you do? So that's where you come back and dovetail back to what you just said with the in-kind distributions.
Yeah, because if the IRA account, certainly when you've got these things, the custodian will take your IRA LLC valuation. They'll use that along with any cash that may be at the custodial account itself, and they'll give you the calculation for your RMD and say, okay, this is how much you need to take this year. And then you've got the option, of course, of taking that RMD out of that particular account, or if you've got another account elsewhere that's in Wall Street, then maybe that's the easiest place to take the distribution. So it doesn't have to be taken out of the self-directed custodial account. It can be taken from another one. But if that's the only one you've got and there's not enough cash there to take that distribution, then you're forced with a decision: am I going to sell the asset so I do have cash to take the distribution, or am I going to take an asset out of the IRA LLC as my distribution,
or a piece of it?
And that's a distribution in kind.
Yeah.
So you're going to take either an asset or a piece of an asset, or you're going to take essentially a piece of the LLC through a shares distribution.
And that's a simple assignment of membership interest.
Yeah, and all those work. So now you end up being a partner in the IRA LLC itself. So now you've got K1s.
Yeah. So that's a solution to the Wall Street objection. The upside is you can always take things in kind, which is typically not something that's contemplated, I don't think, in a Wall Street world that we deal with regularly. The downside of an in-kind distribution is you're triggering some tax exposure. You're not necessarily receiving the cash to pay the obligation. And as you said, if you're taking the whole thing out, maybe you take the whole thing out and do a cash out refi of the property to pay the tax obligation. But if you're taking pieces of it, you can't do that. So you just got to be prepared to understand what the tax liability is going to be. when you're doing these things. But we've got a lot of people that end up wanting to take in-kind distributions, end up owning those assets, don't we? And I guess if you watch one of our videos talking about somebody, we'll talk about potentially buying a retirement home. You can't use that property until it's fully distributed to you, but that would be an example of somebody taking something in kind.
Yeah, even if I've gone through my RMDs and I now own personally 80% of the IRA LLC and my IRA only owns 20% of it, I still can't use that property, still can't work on it, do anything, so still can't go mow the lawn.
Do you remember I think it was probably around 2010, 2012 that one trust company came out. We had that one rep that came in. I won't use names, but he came in talking about sort of the timeshare philosophy on that, where it said, like, to use your example, maybe it's 80-20. Well, the retirement account owns 20% of it, so you can use it 20% of the time. Or no, you could, the retirement account, you could use it 80% of the time. Flip those up. So the amount of ownership you personally had, you could use it to that extent. And I'll never forget them coming in and saying, yeah, because they flew their people in from all over the country and said, hey, this is this thing we're going to do. And I remember you and I said, well, gee, it sounds great. Put it in writing. And yeah, we never saw it. So it's like, okay. So our position, the thing that's interesting, I think really for Tom and me through the years is we've been working together on a lot of things for a long, long time, but we founded Equity Advantage for 1031s in 1991, and we through those years we've got so many different clients, and it's been such a great experience working with all these people. But in the 1031 space, people don't come in here very often. We don't see them that often. And with the retirement accounts, it seems like they come in here a lot more often. Even if we've got a 1031 client for a decade, we won't see them. And then we do a retirement account and they're in here. And it's like, well, what's the difference? Well, this is my retirement. I'm thinking, well, what's the other money? It's sort of strange. So the reason I sort of took that turn and wasted your last 2 minutes was just to say that people really look at they look at the retirement accounts differently. I think in general they're more conservative with them, don't you?
Yeah, I think so. Yeah, and we want to keep them out of trouble. So if they want to be conservative, then that's why we'll always encourage them to contact us anytime they've got questions about this stuff. Because we don't have all the answers, but I think that we've through the years we've got a pretty good team of people that we're always bouncing questions off of and having conversations with some pretty good attorneys. It's hard to find good legal help, good tax and legal help that really know what they're doing with respect to this stuff.
And when those questions come up, it's always fun to see, with sort of circle the wagons and get everyone involved with the conversation and say, okay, so, what do you think of this? And what do you think of that? And what is the best way to do it? And I mean, it's, if you look at the 1031 space, I know you've worked on, for the example, our leasehold improvement exchanges, for example. You've worked with a lot of great people all over the country and fine-tuned that process a lot over the last, that's been 25 years now, right? Because we put the leasehold in place when the RevProc for reverses came out. So a lot of water under that bridge. But couple things, Tom. So you talked about at the very beginning, you talked about the different type of accounts that we work with. And you mentioned basic self-directed IRA, checkbook IRA, solo 401k plans, and rollover business startups. How does somebody decide what they want, or what are the sort of the primary deciding factors between those? Or even if we just start off talking about comparing a basic self-directed IRA to a checkbook advantage IRA LLC. And then, who would how do you decide between those? And then if we start looking at the 401k plans and the ROBs, what sort of helps people decide what they want to do with these things?
Yeah, and then, so the first questions are always going to be, as they are with 1031 too, and a lot of different spaces, I think, is, what do you have and what do you want to do with it? What do you have?
So
what do you
source,
want?
In the IRA or the qualified money world, we're looking at the type of funds it is.
Yeah. What kind of funds do you have currently? What do you want to do with it? And what's your job? What do you do? it ends up being sort of a house cleaning exercise for a lot of people, because people will contact us and they say, we've got an IRA account, and they say, well, I've actually got another 401k account over here. A lot of people have had multiple jobs that they've got 401k accounts that are still sitting at those, at those places of previous employment. And so they'll end up combining a bunch of different accounts sometimes. And we might form, if they've got a bunch of pre-tax dollar accounts, 401k plans from previous employers, IRA accounts, we'll set up one traditional IRA at a self-directed custodian, transfer funds from all these different accounts into them. So if they're wanting to go out and just use cash to go out and buy an asset, then it's all the same type of money, then we can set up a new custodial account. If they're going to make a one-time investment of maybe they're going to buy into a privately held company or something like that, or if they're going to make a single loan to somebody and it's a long-term loan, that's something that they don't really need an IRA LLC for. It does make that investment a little bit more cumbersome at the time of the investment being made than it is if you've got an IRA LLC. But if they're talking about making a single investment and it's a longer term investment, as long as it's not a piece of real estate, I would say that they can get away with just having the custodial account and make that investment itself.
So infrequent, non-time sensitive, non-management required investments.
Yeah, and if they on the other hand are coming in and I'm going to be making multiple short-term loans, and we have a lot of people that do that. It's pretty a popular investment has been lending to builders, commercial and residential. So we'll do a lot of set up a lot of IRA LLCs for people to do that. And so if they are planning on if they're buying real estate, and any real estate investment is going to have some income, some expenses, maybe work that has to be done to it. So you really want to have an IRA LLC for that, not just for the ease of buying the investment, but for the ease of operating it. Because if you don't have that, then every time that you need a check written to somebody, you have to go to the custodian, direct that investment or that check be paid out, and you're going to get charged a fee for it. So it's cumbersome.
I don't understand how somebody buys a rental house with a basic account. And yeah, I know what's involved with it, but you start looking at that purchase sale agreement, even though the forms are assignable, right? I mean, you can't personally tie it up and assign it over. Where do you get the earnest money? Who's signing the purchase sale agreement?
Yeah,
and who's going to sit around?
Yeah, it's got to go back to the custodian, and
because the trust company is the deeded owner of that property. I mean, the transaction is between the seller and the trust company for benefit of that person's IRA, but they don't have the power of the pen. And then once again, renting the thing, the lease agreements, like you said, the utility bills, the insurance, everything that has to happen with a basic account, I really don't get it. And I would bet if you looked at most of those transactions, something's been wrong at some point. I mean, it's just writing the purchase sale agreement.
Yeah, usually if somebody does buy something that way, if they've gone through all the headaches of actually making that purchase that way, they do want the LLC aspect at some point down the road. Because and it doesn't matter if it's a rental property, it's income producing, or if it's bare land. Even with bare land, you've got checks that have to be written out a couple times a year for taxes, insurance, and things like that.
And then when you go to list it to sell it,
yeah,
who's signing the listing agreement?
So
I mean, it's just,
and you'll see stories around the internet. People have nightmares about taking 4 to 6 months for them to actually buy a piece of property if it's just being purchased through the custodian, because escrow's got to work with the custodian. Hopefully the custodian is being pretty responsive to inquiries and
Well,
they can
was
be a pain.
yeah, that was one of the big issues that I don't know. Probably the last 6 months, I met with Troy Eckert Oil and Gas out of Dallas, and we were down in Carlsbad. He had a gathering, and I went and spent the time with him there, and we were talking about IRA investment. And he said that was the big issue that they were having. Their investors were very frustrated because the time involved with making the investment. And I think back in the mid 2000s, you and I flew down to San Francisco to meet with, was it Tom Anderson that owned Penske at the time. And we're sitting there having dinner with him, and he said, well, why do you guys want, why do you feel the need for this IRA LLC? We've got a 24-hour funding policy. And I remember we were looking at him, it's like, well, when was the last time you tried to buy something with your company, right? I mean, it just takes time, and the trust company is going to have a series of things they need to see to make the investment too. So it's going to take you a period of time to get all that stuff together, get it to them, get it approved by them before the investment's going to be made. Where that checkbook IRA LLC.
Yeah, and the custodians they've got, if you're going to make a single investment, and again, maybe it's a loan, for example, it could be secured or unsecured. If that's what you're going to do, and it's going to be one-time investment, they do a pretty good job of on their investment authorization forms. They'll let you know everything that they need in order to make that investment. So they'll have 5 or 6 different documents that they want to see drafted up and provided to them before they'll approve it. So you'll submit everything to them, and then they'll go through, review everything, and they'll let you know if there's a problem with anything, and then they'll make the investment. So they'll let you know what things have to be provided, but it's still going to go through quite a process of approval before they can make the investment. Where if you have an IRA LLC and you want to make a loan, you can draft up the loan document, get it signed by the other party, the borrowing party, you sign it, and you can send a check. And so it's very quick and easy to do so on your own, where if you're having to go back to the custodian each time, then it can be cumbersome.
And a solo 401k plan is going to work the same way pretty much of IRA LLC, right? So you actually, you talked a little bit about those previous employer plans. So when we're looking at an IRA, any IRA can be self-directed. If we're looking at 401k plans, it's critical to understand previous employer plan, current employer plan. If it's a current employer plan, how old are you, whether you've got access to that money for us to do it. And then as far as if we're looking at doing a IRA versus a 401k plan, there's going to be different criteria that's going to meet each of those, for those things. But then also if we want to take, and let's say we're moving IRAs into a 401k plan, we've got restrictions there with beneficiary IRAs, one that's been inherited, or a Roth IRA money. Typically, we're not going to move those two sources of funds into our 401k plans. Our 401k plans do have in-plan rollovers into Roth. So you can have Roth component in your 401k after we put it together, or if you've got a previous, you might have a situation where it might allow us to do some Roth money into it, but typically you're not going to be able to move Roth IRA money or beneficiary IRAs into the 401k plan. So if we look at, so typically our 401k plans are single participant. So if you're self-employed without employees, then that 401k is a nice option. We've been running long on time, so we're not going to talk about the fine points of these different accounts today. I just sort of want to wrap up by saying, hey, if you are working with IRAs, we've got IRA options. The 401k plans we love, they're faster to put together, they're more forgiving. Really, the cost a little less to keep going too, but most people don't qualify for those. So we've got criteria that meets out. But if we start looking at, if somebody came to us and said, hey, I've got IRA money that I can move into a 401k plan, why don't let's wrap up today just sort of talking about the rollover business startup a little bit, and sort of what criteria, what that would be appropriate for and what it's going to take to put that together.
Yeah, so a rollover business startup or a ROBS transaction is going to be, client comes into us and said, I've got some retirement dollars over here, and I want to go out and start a brand new business. Okay, it's not something that can be utilized to fund an existing ongoing business that they've got. But if they want to start up a brand new business and they want to use some of these funds to do so, then we'll set up a rollover business startup for them. And essentially, what it is we set up a new C corp. It has to be a C corp, but we set up a new corporation for them. We then set up a plan under that corp. And as soon as the plan's been established, now we have a place for them to roll money. So again, whether it's an IRA that's being moved into the new plan, the new 401k plan for the new corp, or if it's a rollover of an older 401k plan, those monies can all be moved into it. After the money's in the plan itself, that plan invests money and becomes an owner of the shares of the corporation. So the plan is buying the company shares. We also have the client themselves go in as typically about a 5% owner of shares in the company. So they're going to kick in some cash too. Not uncommon, probably a good amount of money to put in these things just because of costs and things. It's going to be somewhere 80 to 100 grand or so is a good amount of cash to throw into these things. If it's more, great, but you don't want to. If it's less than that, then you have to start looking at is it going to be worth it down the road to be investing 25,000 of my retirement dollars or 50 grand into this if it's going to be cumbersome to get out in the future. Might be worth it to them just pull money out and pay taxes on it to do it that way. But if most of the money that they want to use is inside these retirement accounts, then it can be a great option. But again, they'll go in as an investor, maybe 5% of it, and they've got their retirement dollars through the plan or investing in the company. Now the corporation's got cash through these investments. The corporation's got cash in the bank they can now use to go out and start the business. Use it for equipment, inventory, payroll, and the client themselves is going to be a employee of the company, the corporation, and take a salary.
So I always, in our presentations, I always give the example of we had that retired couple came to us and they wanted to, go buy the mobile home RV park, right? And I think our first response was we'll just do an IRA LLC for you. And in that situation, despite it being more cumbersome, they were both retired. They were going to shove the money in. We just do that one LLC for the two of them. And then they came to us and said, well, gee, we want to live there and we want to be paid for management, right? And so both those things were problematic for the checkbook IRA or 401k plan directly. But the rollover business startup, we sort of shifted gears into that. And so we moved his and her IRAs into the plan. The plan bought the corp bought the park. They got an investment, a place to live, and a job all out of that one transaction, which I think is just an amazing example of what's possible. With that said, why don't, just for the benefit of the audience here, sort of give a scope of the type of businesses that we've put together for people through the years?
Well, I was just talking to one of the first ones I think we put together many years ago is a mattress company. And gentleman's done fairly well with it, I think, and because he was just he was actually calling, had some questions because he was opening up his third location.
Yeah, I think he was like a UPS driver or something when he came to us, and it was during that time.
Yeah, maybe.
Yeah.
But then. So mattress company, we've had car dealerships. We've had a mining
Gold,
gentleman
silver,
that was
palladium mine.
Yeah, gentleman
An
that
Intel
was
guy,
doing
right?
some mining.
Yeah. How about we had something going in Alaska too? We've had a variety of things up there, but the fishing operations.
Yeah, fishing operation up there, and we've had people that have just set them up to basically do flipping of properties.
So why, just since you hit that, why would you do that if you're flipping properties instead of just using IRA LLC?
Well, because they want to do the work themselves on the property and get paid for it. So, it was they were the labor. In this case, I'm sure they hire out other stuff as well, but they were going to be heavily involved with it. Where with an IRA LLC, sure, you can be a manager and set up other people to go in and do work, but they wouldn't be able to do any of the work themselves.
So I think the other reason that looking back on that, the other issue is, and we deal with, we did a video not that long ago for the 1031 channel on dealer status. I think it was that last month, I think. And talking about dealer status and 1031 and the tax consequences and the lack of ability to exchange. And we use the same court case in 9 points to sort of look at retirement accounts and sort of deduct whether somebody's going to be subject to that unrelated business taxable income. So people that want to flip properties, you think you're investors, you're not, you're conducting business. And if you're conducting business, even with a Roth IRA, you're going to have tax exposure on that UBIT. And I think the thing that you start looking at it, and the tax consequence, the unrelated business taxable income tax consequence can be well in excess, especially now that we've got we finally have the tax reform has been approved again, so we know what we're looking at corporate tax rates. Your tax consequence is going to be better with the C Corp doing that stuff. And we did that deal, remember, we did for a finance guy, we did an escrow company not long ago too, and we did not use the rollover business startup in that because he was not involved in any way. And so we did an IRA LLC, but when everything push comes to shove, we were looking at trying to shove that thing back into you have the IRA LLC, but the LLC would have bought that company should be in the form of a C corporation that would have as its shareholder, one of the shareholders, the IRA LLC, and that was all aimed at getting away from the UBIT and the tax consequence through the corporate tax versus the other. So, once again, you start looking at these scenarios and the stories and the time, and that's what's fun. I think you and I were talking yesterday just about what we enjoy about handling 1031s or this stuff. And you made a comment about helping people, whether it's the parking lot at Home Depot, helping somebody load the car with lumber or whatever it might be, or pulling somebody down the lake when they run out of gas or whatever it might be. But I think the thing I really enjoy about our businesses, I think you do too, is just to see people's reaction when you've come up with a solution that helps them get where they want to go. Yeah,
I mean, it's not a hard sell, really. Any of the stuff that we provide to people, it's not a hard sell. And if it's not right for them, it's not right. And we'll certainly tell them it's not right. They don't need us. If somebody's coming into us and after our first question to them back and forth is they'd be better off with just a self-directed account, they don't need an IRA LLC, then they don't need us. Can we put it together for them? Sure, we can, but it's just as easy for them to go to the custodian. They've got everything online. They can do it themselves. Just providing the people with the answers that they may need to get out and make the best investments for themselves. It's satisfying to help people. So.
Definitely. Well, thank you very much for joining us today. Tom, it's always great to sit and do these things with you. So we've got a retirement account, hats on today. So Dave and Tom Moore, the Retirement Bros today. Thank you very much for joining us, and look forward to talking with you soon.
Yep. Thank you. Been fun.
Yep. Bye-bye. Thank you.